C3.ai just held its Q4 fiscal year 2026 earnings call, and it was one of the most candid, unfiltered earnings calls you will ever hear from a public tech company. The founder came back, swung the axe, and made zero apologies. Whether you're an investor, an AI watcher, or just someone who appreciates brutal corporate honesty, you will want to stick around because we're counting down the top 10 most important takeaways from this call, and number 1 might genuinely surprise you. Coming in at number 10, we're talking about the company's internal transformation through agentic AI. C3.ai isn't just selling AI, they're now living it. Across every department, from legal to finance to sales and marketing, the company has adopted agentic AI tools to drive productivity. Engineering teams are using AI for most programming tasks. An entire organization has been told to operate with an AI-first mindset. This is the company eating its own cooking, and it's a meaningful signal about where enterprise AI adoption is headed. At number 9, the enterprise AI market opportunity is enormous and accelerating. CEO Tom Siebel pointed out that the pure enterprise AI application market was roughly $6 billion in 2025, hit $10 billion in 2026, and is projected to reach $15 billion in 2027, a 50% compound annual growth rate. That backdrop makes C3.ai's recent underperformance even more striking, and it sets the stage for just how much upside exists if execution improves. Number 8 is the complete restructuring of the entire company. This wasn't a tweak, it was a top-to-bottom overhaul. Sales, products, federal operations, and services have all been reorganized under new leadership. The products group now consolidates the platform team, applications team, product marketing, and customer services under one senior leader who has been with the company for 14 years. Services went from 7 layers of management down to 3, with dedicated teams now embedded directly with customers until deployments are complete. At number 7, the sales territory overhaul deserves its own spotlight. In a jaw-dropping admission, Siebel revealed that the North American and European sales teams had each been focused on only 100 to 150 total accounts. That's it. Going forward, those same teams will be targeting upward of 1,000 accounts per region, spanning deal sizes from $500,000 all the way up to several billion. The scope of this change is hard to overstate. Number 6 is the FY27 revenue guidance. The company guided full-year fiscal 2027 revenue between $210 million and $240 million. For Q1, guidance is $50 to $54 million. Non-GAAP operating losses are expected to narrow meaningfully compared to the prior year, reflecting the aggressive cost actions already underway. The guidance signals stabilization, not a breakout, yet. Coming in at number 5, the $135 million cost reduction is largely already done. Of the planned annual savings, approximately $130 million in actions have already been executed. Non-GAAP operating expenses for Q1 are projected at $96.5 million, which is over $31 million lower than the same quarter last year. This is real, tangible cost discipline, not a promise. Number 4 is the headcount reduction. The company cut its workforce from approximately 1,075 employees in January 2026 down to roughly 700 today, a 35% reduction across all organizations. Siebel was direct. The workforce actions are complete, the budget is set, and the cost controls are in place. The leaner structure is designed to support faster execution and better unit economics going forward. At number 3, the company's cash position provides a significant runway. C3.ai closed the quarter with $575 million in cash equivalents, and marketable securities. And thanks to the CEO's personal stock purchase, which we'll get next, that balance has since risen to $673 million. Siebel made clear the company is sufficiently capitalized to execute its turnaround without needing to raise additional funds. Number 2 is the insider stock purchase that sent a strong signal to the market. Tom Siebel personally bought 6.17 million shares of C3.ai stock at $11.16 per share, putting approximately $69 million of his own money into the company. That's not a token gesture. That's a founder making a very public bet that the stock is undervalued and that the turnaround plan will work. Actions speak louder than words, and this one spoke loudly. And the number 1 takeaway from this entire earnings call: the revenue collapse was almost entirely a self-inflicted sales execution failure. Siebel stated it plainly: the product is great, the market is massive, customers are satisfied, and C3.ai was still somehow not growing. Revenue had fallen from roughly $100 million per quarter to just $51.6 million. The culprit, according to Siebel, was a broken sales organization with a too narrow focus, poor discipline, and leadership that didn't perform. He accepted full responsibility, called the results laughably unacceptable, and said fixing sales fixes everything. If he's right, this could be one of the more dramatic enterprise software turnarounds in recent memory. We'll find out at the end of Q1.